There is new information that has just been released from the Federal Reserve that could spell disaster for gold and silver. I'll explain why in this video as we explore. First, let me just say that I am overall bullish on gold and silver for 2025, as evidenced in my prediction videos that I did at the end of last year. I still feel strongly that gold and silver are going to do quite well. But the data that has just been released from the Federal Reserve is a little concerning, although there are different interpretations of how that data can be perceived. And we've been here before, and it didn't lead to gold and silver prices crashing. But this time is different because we have inflation. That is the big difference here, as we are dealing with a crisis with our money supply. And it's reflected in the Federal Reserve Bank of New York's information. They are the container, they are the holder of the repurchased reverse repo facility. They are the reverse repo facility. That's reverse repurchase agreements. That's a container of money, essentially, that can be lent out. So what it is, it's a transaction where the Federal Reserve sells securities to a counterparty with an agreement to buy them back at a later date. It's used by the Federal Reserve to manage the money supply by absorbing excess liquidity from the financial system, thereby influencing short-term interest rates. So in some ways, it's probably good because less money coming in means that there's the money supply is tightening, but in reality, it's not. And before we get too much further into this, when we think about lower gold and silver prices, we usually think about that's an opportunity to buy. That's where my friends at Summit Metals comes into play, and they have really competitive prices on gold and silver, so I hope you will check them out at summitmetals.com. In this case, we are looking at a pool of money that is shrinking dramatically, the most ever, the lowest inventory in 1,385 days, according to Malone Wealth, who found this information. The fact that the reverse repo facility has hit its lowest inventory in that amount of time means there's less excess liquidity being parked with the Federal Reserve. It could imply several different things. One is that the banks might be holding onto cash for operational needs or for lending purposes, suggesting they are not flush with excess reserves. Could also mean that a lower use of the reverse repo facility might indicate that the Fed's policy stance might be shifting or that market conditions are changing, possibly towards a scenario where liquidity is tighter. And one thing we know is that it could be a signal that the Federal Reserve, dealing with inflation, might need to essentially raise interest rates because inflation is still sticky and this money is not there, and it has been shrinking because of its coming back into the supply. And if a bank fails, where's this money going to come from? Remember, in 2019, there was to the tune of $700 billion of repurchase agreements that were sent out based off of a low interest rate at the time between these banks. Essentially, it's a bond market where bonds are exchanged for cash. Now, how this all plays out and what it could mean is essentially comes down to liquidity concerns. This low level of reverse repo usage could signal potential liquidity concerns in the banking system, which could be bearish if it leads to a credit crunch or if it signals banks are under stress. That could be a problem, folks, because if we see more bank failures with this little in the container available for these kind of bailouts, then that is a real problem, folks. We've already seen a lot of that money go out from some of these banks swallowing up smaller entities, and many people feel that the bank failures are not done yet. There'll be more of those to come. And so we're going to find out and see if we see more of those happening. They just fall on their own. How many of those can happen before it becomes a real big problem? And it could lead to a stock market shock, maybe even a crash in the market, a small crash, or even a large crash. If that happens, you know what that means. And most of us know that it means that people run to the safety of this. It happens almost every time. Now, there are exceptions to this for sure. But if it really boils down to it, people, when they panic, they don't even think about gold and silver. They're going straight to cash, to core accounts is where a lot of that money goes. They get out of the market, they sell their shares, and it all ends up in a core account of cash where they can take that money and go. Now, in the end, gold and silver will react to it, but it does take some time for that to occur. So that is a big concern here, as some people think, that it means that the market's reaction will depend on how it's interpreted by investors. If the market interprets this as a sign of upcoming accommodative monetary policy, it could be bullish. However, if it's seen as banks being cautious due to liquidity needs, it might not be as bullish. So it can be interpreted in different ways according to this interpretation from Grok. And so given these points, the situation could be considered bullish for markets under the assumption that lower use of the repo facility suggests banks are either lending more or expecting a more accommodative monetary policy environment, which generally supports higher stock valuations. But this is contingent on broader market sentiment and economic conditions. Now, that would assume that the Federal Reserve is going to lower interest rates, and there is pressure all the way from the White House for that to occur. And apparently, according to the Fed Watch tool and statements by Fed Chair Jerome Powell, that is not in the cards. And I honestly think it should not be in the cards. I think they should leave rates where they are at. Inflation is too sticky. It's too high. And we need to get that down. We need to keep those rates up. So we'll see how this plays out. I think there's other ways to be able to stimulate the economy too. One would be lowering taxes and reducing government spending. And if we get the economy to grow, where GDP is up, I think that's going to be a big thing. And a lot of it would probably mean that there's going to be some pain involved to bring some of the jobs and manufacturing back to the United States of America. So we'll see. There are a number of different ways that it could happen. But still, depending on how this is looked, this pool of money not being available is something that could be a big stressor on gold and silver and the markets in general. So I'm very interested to see how this plays out and what kind of interpretation that could be. And I think a lot of it is going to have to do with where that money would be used, and usually it is for other banks and institutions that have come to rely on the Fed. And again, in 2019, I remember I covered it well. Between September and December of that year, there were these repurchase agreements that went out. Not the reversal of what we're seeing here. This is a pool of money where it moves in and out depending on its usage. But if it's not there, how can it be injected back in? That's another question too. It's a very kind of convoluted and complex system with how this stuff happens. It has other implications and the like that could affect it in one way or another. But one good thing about gold and silver is they are not complex at all in terms of what they are. They don't have any properties other than just existing. They are noble metals for the most part. Silver does tarnish, but gold does not react in any way, shape, or form. And they are unchanging. Its value is unchanging. The dollar, however, is quite the opposite. It is destined to die a slow death. And that death will occur at a time when essentially when they orchestrated or manifests itself to be that case where it's transformed or reset. And we could be at the cusp of that happening at some point soon. I don't know what that's going to look like, but a revaluation of the dollar very well could come into play. But until such a time as that, inflation is eroding away its value to the tune of about 98% since 1913 when the Federal Reserve was implemented. So we'll see. But people run to the safety of it because it's what they know. It is the most liquid of liquid assets out there, the dollar. And especially when it accounts for about 58% of all transactions around the world and reserve assets, it's the dollar, and even more so than other currencies, and in many cases even gold. Even though central banks hold gold, dollars are more frequent and held in reserves than gold in many nations, especially those nations that don't have gold or that have sold off half or most or all of their gold, like the United Kingdom and Canada. But gold is something that, and silver as well too, it requires some sort of transaction in dollars. And until such a time when gold and silver actually are the transaction currency, I think that it will always suffer in shocks like this, except for some notable exceptions, and they have to be very exceptional. And so I want to prepare you for that as a possibility. And I'm not saying it's going to happen, because again, this container, or this holding, this vault, I guess, of all this money that's available, to the tune of like $85.65 billion, which is down drastically from where it was about 1,300 days ago, is something that in this economy with this type of inflation is a little concerning. Now, there have been many times in the past where it has been at or near zero, which I think is preferable, but not in a high inflationary environment. So that's where the interpretation is left up to us to figure out. But as one of those fingers of possibilities, if you will, this is where gold and silver may suffer in the market if there is some sort of crash or panic that is set in from these from not having it available for bailouts or loans to some of these other banks, even especially the bigger banks that could be used to buy out the failed banks. So we'll see. So watch that next bank failure if and when it comes, and let's see how the markets react to that and how the Federal Reserve reacts to it, especially given this new information. So I hope you found this video informative, insightful, and educational. I'd like to extend a multitude of gratitude to each and every one of you for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.